What if the real risk in today's market is not what is falling, but what is quietly breaking beneath the surface? Over the past 2 weeks, many investors have been shocked by sudden volatility. Prices swing sharply, headlines change every hour, fear spreads quickly. But here's the truth most people are missing. This is not just about gold and silver. This is a much bigger shift happening across the entire financial system. Welcome to Gold Silver Scope, where we step back from the noise and focus on what truly matters. Let's start with the broader market. Many people still believe that volatility is limited to precious metals. That is simply not true. Some of the biggest technology companies in the world have been under pressure. Stocks that were once called unstoppable are now seeing steady declines. At the same time, retail investors have been pouring record amounts of money into equities. That combination alone should make you pause. When massive inflows meet internal weakness, history shows us that stress is building under the surface. In recent sessions, over 100 companies within the major U.S. index have dropped more than 7% in a single day. Statistically, this type of internal breakdown is extremely rare. Over the past 3 decades, this level of stress has only occurred about 1% of the time, yet the main index itself appears calm, down only a few percent from its highs. This creates a dangerous illusion. On the surface, everything looks stable. Underneath, cracks are forming. Historically, when this type of internal market weakness appears, it often precedes much deeper corrections. That does not mean panic tomorrow. It means pressure is building quietly. And it's not just stocks. Crypto markets have also experienced sharp volatility. Investors everywhere are dealing with uncertainty. This is not a metals-only story. This is a system-wide adjustment period. Now let's address something important. In times of uncertainty, rumors spread quickly. Fear-based narratives gain attention. Claims about sudden confiscation laws, emergency reporting requirements, or surprise government actions begin circulating. These stories can push investors to make emotional decisions. But when you actually fact-check these claims, they often fall apart. There are no new metal confiscation laws. There are no surprise reporting changes. There are no secret deadlines forcing action. Much of that noise appears designed to shake confidence. When markets are volatile, the goal is to stay grounded in facts, not headlines. Now let's move into what truly matters: silver. The silver market recently experienced a sharp drawdown. Many investors were surprised by the speed of the drop. But when you look closely, you can see that forced selling, margin adjustments, algorithmic trading, and negative headlines all combine to accelerate the move. In modern markets, selling can trigger more selling within seconds. Automated systems amplify momentum. In a fraction of time, trillions in market value can disappear. But here is the critical point: price volatility does not always reflect physical reality. We are approaching a major delivery period in the silver futures market. This is where paper contracts can convert into physical metal delivery. Currently, open interest represents hundreds of millions of ounces potentially standing for delivery. Even after some contracts rolled forward into later months, the remaining open interest is still very large compared to available registered silver inventory. Registered inventory is the metal that is actually available to deliver against contracts. And the numbers show a gap. If even a modest percentage of contract holders decide to take delivery, it would represent a significant portion of the available registered supply. This does not automatically mean default, but it does mean stress can show up in different ways. Exchanges may encourage rolling contracts forward. Premiums for immediate delivery can increase. Cash incentives may be offered instead of physical metal. These are the mechanisms markets use to manage tight supply conditions. The key insight here is simple. Stress does not always show up in headline prices. Sometimes it shows up in delivery mechanics. At the same time, there is a persistent price premium in Asian markets compared to Western markets. silver is trading higher there. That premium creates arbitrage opportunities. Metal can be purchased in Western markets and sold into higher-priced markets overseas. Even after taxes and fees, the spread remains meaningful. That tells you something important. Physical demand is real. When physical demand pulls metal out of Western vaults and sends it to regions where it is valued more highly, that shift matters. Over time, price discovery begins to move. Markets that demand real metal gain influence. Markets dominated by paper contracts begin to lose it. This is why silver is often called the canary in the coal mine. It reveals pressure before the broader system reacts. Volatility will continue. That is normal in bull markets. Strong hands stay calm. Weak hands get shaken out. But underneath the noise, something structural is happening. And this is only the beginning of the bigger picture. Now let's zoom out and look at the bigger structural shift that is happening behind the scenes. When we talk about silver stress, we are not just talking about one contract month or one delivery cycle. We are talking about a pattern that has been building for several years. Month after month, large amounts of capital have quietly stood for delivery in both gold and silver. This is not retail speculation. This is serious institutional and sovereign-level positioning. If even a fraction of current open interest in silver decides to take delivery, it places immediate pressure on available registered inventory. And remember, registered inventory is not total silver in vaults. It is only the portion available to meet delivery demands. That distinction matters. If delivery requests spike, exchanges typically have two choices. Either allow inventory to drain quickly or increase financial incentives to prevent physical withdrawal. They can raise premiums for rolling contracts forward. They can encourage cash settlements. They can widen spreads between futures months. All of this helps slow physical outflows. This is how pressure builds. It does not always explode in one dramatic event. It tightens slowly. Another signal of stress is backwardation. This happens when near-term prices are higher than future prices. In normal commodity markets, future prices are usually higher because of storage and financing costs. But when immediate demand becomes urgent and physical supply is tight, the market can flip into backwardation. That tells you sourcing metal is becoming difficult. Market makers rely on hedging. They depend on being able to source physical metal easily when needed. If sourcing becomes harder, risk increases. When risk increases, volatility increases. At the same time, we are seeing persistent physical demand in Asia. The premium between Asian exchanges and Western markets has remained elevated. Some people try to explain this away with taxes or tariffs, but that does not fully explain the size and consistency of the spread. The value-added tax in certain regions is paid when metal leaves the exchange system, not when it enters. If metal stays within the system, that tax does not immediately apply. This means the arbitrage opportunity remains powerful. Traders can buy silver in Western markets at lower prices and sell into higher-priced markets overseas. Even after costs, the margin can be significant. When this continues for months, it steadily drains Western supply. And here is the important shift. Price discovery slowly begins moving toward markets where physical demand is strongest. For decades, London and New York dominated precious metals pricing through paper contracts. But when physical demand grows stronger elsewhere, influence changes. If real metal keeps flowing east, while paper claims pile up in the West, the imbalance grows. This is why many analysts believe silver is exposing the weakness of a paper-heavy system. Paper contracts represent claims on metal. But if too many claims exist compared to deliverable supply, tension builds. Now let's connect this to gold. Central banks around the world have been buying gold aggressively. Recent surveys show that a large majority of central banks expect gold to represent a higher percentage of their reserves within the next 5 years. This is not marketing. This is policy positioning. Why are they doing this? Because trust in the global financial system is declining. Fiscal deficits are expanding. Debt levels are rising. Geopolitical tensions are increasing. Counterparty risk is no longer theoretical. It is visible. Gold has no counterparty risk. It does not depend on another nation's promise to pay. It does not require trust in a banking system. That matters in volatile times. There have already been hundreds of tons of gold purchased by central banks in recent years. This level of accumulation is historically significant. It suggests a long-term strategic shift, not a short-term trade. Now look at global economic competition. Major nations are investing heavily in infrastructure, energy grids, and advanced technologies like artificial intelligence. Building modern energy systems requires massive capital. Upgrading national power grids requires trillions of dollars. Reshoring manufacturing requires even more. Where does that money come from? In countries already running large fiscal deficits, the answer is usually increased debt or currency expansion. Printing money may provide short-term relief, but it weakens the currency over time. When currencies weaken, hard assets benefit. This is the deeper story. It is not about one rumor. It is not about one contract month. It is about a structural shift away from full reliance on a single reserve currency system. Some countries are reducing exposure to foreign government bonds. Others are increasing gold reserves. Energy trade is gradually diversifying. These are slow-moving changes. They do not happen overnight. But once momentum builds, they are difficult to reverse. Silver, being both a monetary metal and an industrial metal, sits at the center of this shift. It is needed for energy infrastructure, solar technology, electronics, and advanced manufacturing. At the same time, it has monetary history. That dual demand creates powerful dynamics. Volatility will continue. There will be sharp sell-offs. There will be sudden rallies. But the long-term fundamentals are not weakening. In many ways, they are strengthening. Strong bull markets are designed to test conviction. They shake out weak hands. They create doubt. They create emotional reactions. But if you step back and look at central bank buying, delivery stress, inventory levels, global infrastructure spending, and currency pressure, a bigger pattern becomes clear. The system is adjusting, and precious metals are quietly positioning themselves at the center of that adjustment. As we look at the final picture, one thing becomes very clear. The real movement in gold and silver is not driven by short-term price swings, but by long-term structural demand. Markets may fall sharply one day and recover the next, but the bigger trend is shaped by supply pressure, delivery demand, and global economic uncertainty. When large amounts of open interest stand for delivery in the silver market, it shows confidence in taking physical metal instead of just holding paper contracts. If even a small percentage of those contracts demand real delivery, it can create pressure on available registered inventory. Exchanges then respond by encouraging contract rolls, offering cash incentives, or adjusting premiums to manage supply. This is not panic. It is system management under stress. At the same time, we are seeing strong buying activity from central banks in gold. Many central banks now believe gold will hold a larger share of their reserves in the coming years. This shift shows concerns about currency stability, debt levels, and counterparty risk. Gold is seen as a reserve asset that does not depend on promises or political conditions. That trust factor is becoming more important in uncertain times. Silver also plays a unique role because it is both industrial and monetary. As technology expands and industries grow, demand for silver increases in energy systems, electronics, and advanced manufacturing. If supply growth does not keep up with rising demand, price pressure becomes inevitable over time. The combination of industrial use and investment demand makes silver sensitive to global economic expansion and financial stress. There is also a noticeable price difference between Western markets and Asian markets. In some regions, silver trades at a higher premium. This creates arbitrage opportunities where traders move metal from lower-priced areas to higher-priced markets. Even after taxes and costs, the spread can remain attractive. When this continues consistently, physical metal gradually moves towards stronger demand centers. That movement slowly tightens supply in the original market. Backwardation and tightening spreads are additional signals that sourcing physical metal is becoming more challenging. When near-term prices rise above future prices, it often means immediate demand is stronger than long-term supply expectations. Market makers then face difficulty hedging positions smoothly. This increases uncertainty and can lead to sudden price adjustments. Looking at the bigger economic picture, governments around the world are investing heavily in infrastructure, power grids, technology development, and artificial intelligence. These projects require massive capital. If budgets are already stretched and debt levels are high, funding often comes from increased borrowing or money creation. Expanding currency supply without matching economic growth reduces purchasing power over time. In such an environment, investors naturally look for assets that preserve value. Gold and silver have historically served that role during inflation, financial instability, and currency weakness. They act as protection against system risk and long-term monetary uncertainty. The key message is simple. Daily volatility should not distract you from the bigger trend. Short-term price drops often create fear, but they can also create opportunity for long-term investors who understand the fundamentals. The supply dynamics, delivery activity, central bank accumulation, and global economic shifts all point toward sustained interest in precious metals. Markets will continue to test patience. Sharp corrections will happen, headlines will try to explain every move, but the underlying structure remains strong. If you want to stay updated on real analysis about gold and silver, long-term trends, and market structure, follow and support Gold Silver Scope for more clear insights. Disclaimer: this content is for educational and market analysis purposes only. It is not financial advice. Always do your own research and consider your financial situation before making investment decisions.